And now we're going to switch gears, and we've been talking about assets and current assets and long-term assets. Now we're going to look at liabilities, and what we're looking at in particular right now are short-term liabilities, where we're going to maybe take an accounts payable and turn it into a note payable for 180 days. So anything that's going to be paid within the year, and that's going to involve a note payable and a warranty and payroll at this time. So those are the three things we're going to look at. This is notes payable, and we borrow $110,000 in cash on May 15th, and it's to be paid in 180 days, and it's an 8% note. What note does this mature? What day does this mature in? So a really quick and easy way of doing this, for my notion, is, as soon as I can find it, guys. Hold on, let me see where to go. Here. Use the internet. Simply type in at what is 180 days from May 15th, 2015. And then if you click on 180 days, it's going to tell you it's November 11th. You could also do this manually by using the book. The book gives you a very good schematic, and I think I showed that to you in the overview also. So we would find that that is due on November 11th, 2015. Easy way to do that. The next thing we look at is the face value of the note is $110,000. And you want to prepare the journal entry to record the issuance of the note. Well, if I'm going to have a note payable, I had better receive some cash, and that cash will be for $110,000, and I will show a liability of a note payable at $110,000. Relatively easy little journal entry. So now we want to figure out how much our interest is. So it's an 8% note. It's 180 days, and we're going to use the 360 360-day year instead of 365. So how do I figure out how much my interest is? Well, you simply take 110,000 and multiply it times the 8%, which is going to give you $8,800. But that's for the whole year, because this rate is on 12 months. I want to know what it is for 180 days. So now I need to either, one, break this down into a decimal, or simply do 8,800 times 180 divided by 360 will give me total interest due on this note of $4,400. So when I pay this note off, what is it going to look like? Well, first of all, I know I'm going to debit the note payable because I'm getting rid of it. I'm going to show an interest expense of $4,400 for this interest I'm going to pay. And my cash is going to have a credit for $114,400. Even though I only received $110,000, I still have to pay the interest, and that gives me a total to be paid of $114,000. So that's a very quick, easy way of figuring out the interest and how much we owe for it. Next thing we will look at is warranty. And warranty is kind of interesting. These are the figures are the journal entries that you're going to have to make. I guess if I kind of cover these up, it might make more sense. All at once is a bit much. So, when we have warranties, when we have products that we have warranties on, we have to keep track of how much we may have to spend, because that's a liability. That's a short-term, usually liability. So let's kind of look at the scenario. This company sold a copier costing $7,500 at a 2-year parts warranty to a customer on August 16, 2015. And it cost the company that's selling it $7,500, right? But we sold it for $15,000 because we're going to make a profit on it. They use a perpetual inventory system. So we kind of know that they're going to show 2 entries at the sale, right? Cost, or the sales and the cost that goes into the inventory. So that's what this very first entry here is. We show it as a sale at $15,000. Then we show it as a cost of goods sold and taking it out of inventory. Now, if we didn't have warranty expense on it, we're done. We didn't have any warranty on it, but we do have. And it keeps going. It says repairs cost $103,103. And then on November 22nd, 2016, it had on-site repairs. And that cost $103. And that was taken out of the repairs parts inventory. Now, these are only repairs required in 2016 for this copier. Based on experience, Hitsu expects to incur warranty cost equal to 5% of the dollar sales. It records warranty expenses with an adjusting entry at the end of each year. Okay, that's an awful lot of information. So first of all, you've got to record the warranty expense at the end of the year. And that amount is going to be 5%, correct, of $15,000. So 5% of $15,000 is $750. So we record that. And that goes into an estimated warranty liability account. So here's our expense, and here's our estimated warranty liability. Now, down the road, okay, we recorded this here, this one, on December 31st, 2015. We didn't pay out anything for a warranty until 2016. So that's our very next entry. And how much did we pay out? We paid out $103. This comes out of our repair, and this goes against the warranty liability. So that estimated warranty liability kind of goes up and down, just like the accounts receivable allowance did. We kind of watch that, but because we actually, even though we show this expense, we're saying it's an estimated liability. We may have to come back and reevaluate this. So this will be like a contra account that will keep track of how much liability, estimated warranty. We may find out that this 5% of dollar sales is too high. And then we'll have to adjust it, and then we'd also have to adjust how much warranty expense we put out. So that's just a very quick look at how warranties set up. They can get really complex. So this is something you're really glad that you have a computer for when this gets started. So just a brief, very brief overview of a warranty expense. Now we've got, we're going to do payroll next, so I'm going to end this one, and we'll start a whole new slide for the payroll.